If you own your home and you were born before 1970, there are local property tax relief options available in many states that you need to understand before your next property tax bill arrives. And I say need to understand because this is not a suggestion. This is not financial advice. This is information on how your local property tax assessment may include age-based exemptions or freezes depending on where you live. States and counties handle these programs. They are not new federal mandates. And the reason many people overlook them is because the details sit in county rules that get less national attention than broader budget stories. Nobody always pulls every local option out and explains what it means for you. So I am going to do that right now. The rules are different depending on whether you were born in the 1940s, the 1950s, or the 1960s. And the group that may save the most money is also the group that often needs to act soonest on local deadlines. Now, I know what some of you are thinking. Property taxes are local. They are set by your county, your city, your school district. Why would any broader framework affect your property tax bill? And that is a fair question. Here is the answer. Congress does not set your local tax rate. What exists in many places is a state or county framework that determines how your home is assessed and what exemptions you may claim based on your age. Your county still sets the rate, but the assessed value your county uses to calculate your bill may include caps, freezes, and exemptions that vary by location. These protections are often age-based. They are sometimes income-based. They are sometimes means-tested. If you own your home and you fall within the age range for your area, you may qualify. That is the local reality. Here is what I am going to cover. I will walk through what this means for homeowners born in the 1940s first, because that group often faces the most time-sensitive local deadlines. Then I will cover homeowners born in the 1950s who may have a different set of benefits. Then homeowners born in the 1960s who may have longer windows to plan. Stay through all three sections, even if only one applies to you, because at the end I will cover one common step that applies to all three groups equally. It is checking with your county assessor about forms most homeowners have never submitted, and it can help you claim every exemption you may be owed. Before we get into the details, if you are a homeowner over 55 and you want to stay informed on every benefit, tax, change, and filing deadline that affects your money and your home, subscribe right now and turn on the bell so you do not miss these updates. I cover these changes the week they matter, not months later when local deadlines have already gone by. Now, homeowners born in the 1940s. If you were born between 1940 and 1949, you are between 76 and 85 years old right now. You have likely owned your home for decades. You have watched your property tax bill climb year after year, even though your income has not climbed with it. And you are the group that many states give the most immediate local relief options to. There are three common provisions that may apply specifically to you. The first is the property tax freeze. Many states already had property tax freeze programs for senior homeowners. The problem was that those programs were often opt-in. You had to know they existed. Find the application, fill it out, and submit it to your county assessor. Most homeowners born in the 1940s never did that. They did not know the program existed. Their county did not always send them a letter. Nobody told them. What many states do is this. They offer enrollment for homeowners born before 1950 who own and occupy their primary residence. You may still have to find the form. You may still have to apply. The freeze is not always automatic. What this means practically is this. Your home's assessed value may be locked at a prior level. It does not matter if your county reassesses your neighborhood next year and says your home is worth more. Your assessed value may stay where it was if you qualify and apply. Let me show you what that is worth in dollars. Take a home assessed at $250,000 in a state with a 2.1% effective property tax rate. That homeowner is paying $5,250 a year. Now, say the County raises the assessed value by 12% next year, which many counties have been doing. That is a $30,000 increase in assessed value, which adds $630 to the annual bill. Over 3 years with compounding assessments, that homeowner would pay an extra amount compared to a frozen value. That is the money a freeze may save you, hundreds or more a year every year for as long as you own that home. And I want to be clear about which states this applies to. As of right now, many states and the District of Columbia have some form of property tax freeze or deferral program for seniors. If you live in one of those states and you were born before 1950, the local enrollment may apply to you. If you live in a state that does not have a freeze program, check whether your state is considering one. That means every homeowner should verify coverage with their county. If you are in this age group and you have not received a notice from your county confirming any enrollment, call your county assessor's office this week. Tell them you were born before 1950 and you want written confirmation about any freeze at a prior level. Ask them to send you that confirmation in writing. If they say they do not have a freeze program yet, ask them for any timeline on local options. Get a name and a direct number. Follow up in 30 days. The second provision for 1940s homeowners is the expanded homestead exemption. Many local homestead exemption thresholds offer higher amounts of assessed value for homeowners over 75. This is a direct deduction. It comes off the top of your assessed value before the tax rate is applied. So if your home is assessed at $250,000 and you claim a full local exemption, your tax is calculated on a lower amount instead. At a typical rate, that may save you hundreds per year depending on where you live. The form to file is at your county assessor's office. It is called the Homestead Exemption Application, and you need to update it if you previously filed under an older threshold. Call your county assessor and tell them you want to refile under the current local threshold. If you never filed a homestead exemption at all, you may have been leaving money on the table for years. Under older thresholds, that was a smaller amount off your assessed value. Under newer local ones, it can be larger. At a 2% tax rate, that is money per year you may have been overpaying. Years of missed homestead exemption can add up. You cannot always get past amounts back, but you can stop further overpayment today. Do this now. Do not wait for your next bill. The third provision for 1940s homeowners is reverse mortgage-related protections that may exist under federal housing rules. If you are over 76 and you have a reverse mortgage, there are existing federal provisions that protect you during certain review periods. Here is the situation this addresses. Many homeowners born in the 1940s took out reverse mortgages and also received VA benefits. When the VA reviews your benefits, there can be a period where your benefit payments are paused or reduced. During that review period, some reverse mortgage lenders have initiated foreclosure proceedings because the homeowner's income dropped below the loan's occupancy requirements. Existing rules limit that. The provisions restrict reverse mortgage lenders from initiating foreclosure on certain homeowners during an active federal benefit review period. This applies to VA benefit reviews, Social Security, disability reviews, and pension recalculations in many cases. If you have a reverse mortgage and you have a pending benefit review of any kind, here is what you do. Send written notice to your loan servicer. In that letter, state your name, your loan number, your date of birth, and reference the applicable senior homeowner protection rules. Request written confirmation that no foreclosure action will be taken during your review period. Send this letter certified mail. Keep the receipt. Do this within the next 30 days. Now, homeowners born in the 1950s, if you were born between 1950 and 1959, you are between 66 and 75 years old. Many of you are recently retired or within a few years of retirement. Your home is likely your largest asset, and your property tax bill has been growing faster than your retirement income. Local rules address this with 3 separate common provisions. The first is the assessment cap. This is often the single most valuable provision for 1950s homeowners. Many states set annual caps on assessment increases for primary residences owned by homeowners in senior age ranges. To understand why this matters, you need to know what has been happening without the cap. In many counties across the country, assessed values have been increasing by 8 to 15% per year. If you own a home assessed at $300,000 and your county increases that value by 10%, your assessed value jumps to $330,000. The next year, another 10% takes it to $363,000. In just 2 years, your assessed value has grown by $63,000 under a typical 3% cap. That same home goes from $300,000 to $309,000 in year 1 and about $318,000 in year 2. The difference after 2 years is tens of thousands in assessed value at a mill rate between 2 and 3% that may save you between $100 and $200 in annual tax savings. And that gap widens every single year because the cap compounds over 5 years. The savings can grow to over $1,000 per year. Over 10 years, it can exceed larger amounts per year. Let me say that differently so it is absolutely clear. If you do nothing and let your county assess you at 10% per year for the next 10 years, your $300,000 home could be assessed much higher. Under a 3% cap, that same home will be assessed far lower. That is a large difference in assessed value. At a 2% tax rate, you would be paying thousands more per year in property taxes than under a cap. That is not a small number. That is like a second mortgage payment. And here's the part that most people miss. Caps are usually applied going forward. If your county already applied a higher increase, you may be entitled to a local correction process. To claim this, you need to file the appropriate senior residence assessment form with your county assessor. Local filing deadlines vary and can be soon. Do not wait. Download the form from your county assessor's website or call their office and request it. Fill it out, submit it. If your county already assessed you above the local limit, you may receive a corrected bill. The second provision for 1950s homeowners is the school tax exemption. If you are over 65 and you receive Social Security benefits, you may qualify for a school district tax exemption of a set amount in assessed value in many places. This stacks on top of the Homestead exemption. It does not replace it. You get both where available. Here is why this matters more than it sounds. In states like Texas, Georgia, and South Carolina, school district taxes make up 40 to 60% of your total property tax bill. A local exemption on the school tax portion may save you between $400 and $600 per year, depending on your local school district tax rate. To claim this, contact your county assessor and ask for the Senior School Tax Exemption application. You will need a copy of your Social Security benefit statement, which you can download from ssa.gov. File the exemption application with your county assessor. In most counties, once you file this, it renews automatically each year. The third provision for 1950s homeowners is the existing capital gains exclusion. You already know that when you sell your primary residence, the first $250,000 in capital gains is excluded from federal income tax if you are single, or the first $500,000 if you are married. Filing jointly, that has been the law for years. What has been discussed is possible expansions, but the current rules remain the base. That means if you are single, your exclusion is $250,000. If you are married, it is $500,000. This matters because many of you bought your homes in the 1980s or 1990s for $100,000 to $200,000, and those homes are now worth $500,000 to $800,000. The gains have outpaced the exclusion in some cases. Any future change would need to pass. Here is an example. Say you bought your home in 1990 for $120,000. It is now worth $620,000. Your capital gain is $500,000. Under the current rules, A single filer would exclude $250,000 and owe federal capital gains tax on the remaining $250,000. At a 15% long-term capital gains rate, that is $37,500 in federal tax. Any expansion would change that math. If you are considering selling your home in the next few years, talk to your tax preparer about the current exclusion. Make sure they apply it correctly when they file your return. The exclusion is claimed on Schedule D of Form 1040, and it requires proof of ownership duration, which is your deed or closing documents from your original purchase. Now, homeowners born in the 1960s, if you were born between 1960 and 1969, you are between 56 and 65 years old. You are either approaching retirement or you just entered it. Your home may still have a mortgage. Your property taxes are a significant line item in your monthly budget, and local programs may give your group planning options. There are 3 provisions that may apply to you. The first is the Deferred Payment Program. Many states offer property tax deferral for homeowners in certain age ranges who are near retirement. Here is how it works. You apply through your county assessor to defer your annual property tax payment. The deferred amount is not forgiven. You still owe it. But instead of paying it now out of your pre-retirement income, the balance accrues at a low simple interest rate and becomes due when you sell the home or upon your death, at which point it is paid from the estate. Compare this to what happens if you do not pay your property taxes on time without the deferral program. Most counties charge penalty rates of 8 to 12%. Some counties begin lien proceedings within 12 months. The deferral program replaces that penalty structure with a lower simple interest rate, which is often lower than inflation. What this means practically is this. Say your annual property tax bill is $4,000. Over 5 years, you defer a total of $20,000. At 2.5% simple interest, the total interest over those 5 years is $2,500. Your total obligation at the end of 5 years is $22,500. Now compare that to paying $4,000 per year out of your retirement savings, which could be earning 5% in a conservative bond fund. The opportunity cost of pulling that money out of savings over 5 years is approximately $5,000 in lost returns. The net benefit of deferring instead of paying can be positive over the 5-year period. Plus, you maintain a larger cash reserve during the years when your income is transitioning from employment to retirement. To enroll, contact your county assessor and request the property tax deferral application. You will need to provide proof of age, proof of home ownership, and a statement of your planned retirement date. File this before your next property tax due date. And understand this, the deferral does not affect your credit score. It does not create a traditional lien on your home in the usual sense. It creates a deferred obligation that is settled at sale. Your home remains fully yours. You can refinance. You can make improvements. You can leave it to your heirs who would settle the deferred balance from the proceeds. This is not a debt trap. It is a cash flow tool for the window before retirement when your expenses are high and your income is about to change. The second provision for 1960s homeowners is possible renovation tax credits. There are federal and state credits or deductions for aging-in-place home modifications in some cases. Not always a credit, sometimes a deduction. That means it may reduce your tax bill. Here is what qualifies in many programs: grab bars in bathrooms, walk-in tubs or roll-in showers, wheelchair ramps, widened doorways, stair lifts, non-slip flooring, lever-style door handles replacing round knobs, first-floor bedroom and bathroom additions. These are modifications designed to let you stay in your home safely as you age instead of moving to assisted living or a nursing home. Maximum amounts vary. Let me put this in perspective. The average cost of assisted living in the United States is around $4,500 per month. That is over $50,000 per year. A home modification that lets you stay in your home for Even one extra year can save significant amounts after any credit and potentially more over a decade. Credits or deductions are available to qualifying homeowners who make modifications to their primary residence. You claim them on the appropriate schedule of your Form 1040 when you file your federal income tax return. Keep all receipts, keep all contractor invoices, take before and after photos of every modification. You will need a contractor's statement, confirming that the modifications meet aging-in-place standards, which any licensed contractor familiar with accessibility requirements can provide. Timing windows vary by program. If you are planning any bathroom or accessibility upgrades in the next few years, research current options now. The third provision for 1960s homeowners is any local downsizing incentive. Some areas offer limited tax credits or relief for homeowners who sell a higher-valued home and purchase a lower-valued replacement. The purpose of such incentives is to free up housing inventory. Homes valued higher are often in demand from younger families. Homes valued lower can be more appropriate for retirees who no longer need 4 bedrooms, a large yard, and a 2-car garage. Any credit is usually available once per taxpayer under specific rules. To claim it, you would file the required form with your tax return for the year the purchase closes. You will need the settlement statements from both the sale and the purchase showing the respective values. What this means practically is this. If you have been thinking about selling your larger home and moving to something smaller, easier to maintain, and less expensive, check whether any local or state program offers help. Combined with the existing capital gains exclusion and combined with assessment caps and school tax exemptions that may apply to your new lower-valued home, the total savings from downsizing can be meaningful in the first year. If you are on the fence about downsizing, run the numbers. Add up the property tax savings on the smaller home, the capital gains exclusion on the sale, any available credit, and the reduced maintenance costs. For many homeowners in this age group, the math can favor making the move. And here is something else to consider. A lower-valued home in most markets means lower property taxes, lower insurance, lower utility bills, and lower maintenance costs. I cover these changes every single week on this channel so you never miss a deadline and you never leave. Money on the table. Share this video with a homeowner you know who was born before 1970. They need to see this. I will upload part 2 soon. Subscribe to my channel for valuable content.